All right, everybody, welcome back. It's Friday. We got non-farm payrolls today, so we have the opportunity for a liquidity gap. This is not the same as a price gap. It's something, if you've been to any of my morning briefings when we've talked about economic events, you've heard me go through this spiel before, but if you're new, well, you'll hear it for the first time. You can always follow up later with questions. What we're looking for is an economic event. I like the ones at 8:30, but these can happen anywhere throughout the trading day that causes a really big candle that looks like this right here. So let's start with one on an 8:30 time frame. Non-farm payrolls, you can get CPI, PPI. This happens frequently. So at 8:30, we're going to get data. It very likely will cause a candle that looks like this. I don't care if it's red or green, if we go up or down. But one thing you'll notice on this example, when we went down, there was almost no candle to the upside, right? No wick, no movement up. A tiny, tiny little tail there. It's okay. And we closed near the end of the candle. If we were to break this candle into 4 quarters and just focus on the halfway point, we want it more than half. We want it more than 3 quarters, closing near the end of the move. A little bit of a base. It tests the midpoint. We get into the RTH, and around 11 o'clock, we get the gap closed. So that's one example. Here's another one. This one actually was CPI. And you'll notice almost no wick on the bottom. It closed in the upper 3 quarters area. The next candle got stuck in that wick. It's one of the reasons we don't want to see a really big wick there, right? More than half. Continued the move, built the base, got into the regular trading hours, came back down, got the gap closed near 11 o'clock. Another example, same thing, almost no wick, closed near the other end. This one really didn't build much of a base, started working its way back, and it got the gap closed around 10:30, a little early that day. This is what we don't want to see. We don't want big wicks on each side. We don't want price coming back to close near where it opened. Now, even though this isn't what we want to see, if we measured this entire candle and projected to the upside 50% of that candle and to the downside if we had gone down, then we can mark very likely where this stalled at the halfway here. That's about 50% or 100%. So these candles, even if they don't give us the gap close that we're looking for, we can still use them in our analysis. Here's another one where it closed near the 50% mark. We wouldn't have wanted to use this for a gap close. It did close the gap, but it closed it really fast. It's not what we're interested in. And if we marked the halfway point, you can see how it was still useful later in the day. I like to use the 111 and the 1236, and you can see how that was effective later in the day. So these candles can be useful throughout the trading day, even if we don't get to use them for a gap close. Here's another one, had wicks on each side, wasn't really interested in doing a gap close on this. It did get the gap closed around 10 o'clock. That'd be the move down here. But if we measured that on each side, there's the 111 tag. When it broke out of the first candle, there was a 111 tag. 1236 tested multiple times, half back tested multiple times. So we can use these candles. Even if you don't want to trade the gap close, if I can help you from going the wrong direction, okay, if we think about these big push events, if you're new to trading and you saw that and you thought, oh, it must be really bullish, I'm going to go long at the open. Yeah, that didn't work out too good. So if I can at least prevent you from making that mistake, then, you know, going through these still has some value. So another example of what we don't want, big wicks on each side. Price closing near where it opened. But if we had drawn this candle out and projected it to the downside, we'd see that it hit the 50% mark and 100% mark. Even if I had marked the midpoint of this candle, it looks like it got tested and it was the stall point later in the day here. So we're going to get CPI non-farm payrolls today at 8:30. And it's likely that we're going to get one of these candles. We obviously won't know until we get it. And while I didn't have a picture of it, it is possible that we get a really big candle and then price continues to move in the direction of that really big candle. It's always possible, right? So let me bring one of those back up. This big move to the downside, for an example. It didn't have to turn around and come back. Price can do what it wants. All right. So while most of these examples showed a big move and a gap close, or a big move with the wicks on each side and price chopping around within that wick range, it doesn't have to. It can make the move and just continue to go. So in this case, it would have continued to go lower and lower and lower. Or if it was one of those to the upside, then it could have continued to just move on up. So nothing is guaranteed. We always want to find the setup or the opportunity to trade and not just, blindly trade. So markets are on pause. We're waiting. Nothing's really down all that much. Nothing's really up all that much. The entire market is looking for this information. Now, there's a lot of things that everybody's focused on. We're still getting numbers from the previous administration. That, of course, will change next month when we're in March and we're looking at February's numbers, but we're in February looking at January's numbers. So there's that. And then there's the idea that there's always a January component in the seasonality, especially when it comes to job numbers. Then there's revisions, and I believe they're going to actually change the way that they get the numbers. And this isn't new either. A lot of administrations adjust or tweak the way that the numbers are run. That's just the nuanced way that things go, right? So the numbers we get today could be something that the market is unfamiliar with or doesn't like or doesn't trust, either because it's a new system that's getting the numbers, or we had the wildfires and we have the seasonality adjustment. So these numbers could just be something the market doesn't like at all. We're going to get a lot of Fed speakers today. Inventories, consumer sentiment, consumer credit, but most of the data that we're going to get today will be done by noon, by lunch. This consumer credit change, for maybe that will add a little depth, but I doubt it, right? I would never want to discount data and say it doesn't matter, but it's unlikely to cause any market movement at all. So we should be done by noon or maybe after this Fed speaker. And of course, we got ECB speakers chipping teeth. But I don't think they're going to say anything that'll rock the market before we get non-farm payrolls. Not much has changed when it comes to call wall, put wall, volatility trigger, 0 gamma, 10-day, 20-day, 3-week, 10-week. If you look at where we're at now compared to where we were at yesterday in the Globex, it's like deja vu all over again. So we need these numbers. We have a market maker move this morning because they're hedging. Right now, if you haven't heard me go through this before, market maker move is something that only Thinkorswim has. The creators of Thinkorswim, way back in the day before they sold it to TD Ameritrade, they were wanting to offer people something that they couldn't get on any other broker. I know it sounds exciting, right? They even gave it a really good name, market maker move. It's right up here. And what it's focused on is the front expiration in the options implied volatility versus the next one out. Now, I've read a lot of articles on this, done a lot of background on it. It's usually used for companies that are about to report earnings, and none of their articles ever really talked about using it on futures. But that's their problem, not mine. The idea behind it is when there's out of the money options that are traded on the front end, it will raise up the implied volatility average, right? And these averages, every options platform, Tasty Trade, Thinkorswim, all these guys, they have this implied volatility average. Now, it's proprietary. They don't tell us all the ingredients on how they get this number, but we know some of the information. Some of it uses the implied volatility on each one of these options strikes that are out of the money. And it uses a square root of time formula. And then it comes up with this average. So if there's a lot of out of the money options being traded, then it will affect the average. And if the front average gets higher than the next average out, we end up with a market maker move. They're always hedged, right? When you hear me saying, hey, they're hedging this morning, it's not like they weren't hedged and they were just running around all willy-nilly. They were already hedged. They're adding additional hedging this morning. And while retail often looks at a hedge as though it's just a trade, a chance to potentially make some money, when they hedge, it's just cost. They're not doing it for profit. They're not trying to get gains. They're just trying to limit their risk. And no matter the outcome, it's just costing them more money. So they're not going to do it unless they feel it's warranted and they need to. That's a nice little heads up for us that says, look, they're so worried about the non-farm payrolls this morning that they're spending money to hedge in front of it. We are above the weekly pivot still. We're exactly like we were yesterday. The only difference when we look at the floor pivots is that today's channel is much narrower than yesterday's channel. Now, a wide channel implies that even if we do attempt to break out, the breakout will fail. When we have a narrow channel, it says if we attempt to break out, the breakout could really grow legs and we could make some moves. These channels don't make price do anything. We won't break out just because the channel is narrow, and we won't go sideways just because it's wide. It's just giving us insight on what we should expect if the market attempts to break out or if the market, stays range bound. This is one of those skinny days, skinny channel, narrow channels, and one of those expanded days. There's another one and one of those expanded days. Now, I can find just as many where there was a really narrow day and we didn't do anything. So, you know, it's not set in stone that, oh, well, we got a narrow day and we're going to break out, right? Now, we don't have the AM edition of the Founders Note, but when we get it, you'll want to take a look at that too. Actually, they came out with it right after I started the briefing, but I haven't had a chance to look at it yet. But in the Founders Note, they have what they call the Gamma Index. And that Gamma Index goes from a -4 to a +4. And when it's in negative territory, it implies that if we break out, it's going to grow legs and it's going to run. So that's two different tools that you can use on the day to help you wrap your mind around, okay, if we break out, could we actually go somewhere? If the channel is really narrow, that says if we break out, we could run. And if the gamma index is negative, that says if we break out, we could run. If they agree with each other, then even better, right? And if they don't, well, maybe they just cancel each other out. But there's a number of tools out there that go into that concept of, hey, if we break out today, can it really go anywhere? Just remember, none of those things make price break out. We managed to get through last week's point of control, and we're well above our own week's point of control. We're stuck around that 6,100 level. Now, we've gone above it and below it a few times, so 6,100 isn't resistance. Right now, it's more like a magnet. We're just stuck there waiting on this data. To the upside, we do have another point of control, 6,130. That's a Friday close. It's the December 18 FOMC gap down level. It's this point of control. So it's a number of things. We know it's not necessarily a resistance level because we punched through it last week on Friday. We weren't able to keep it, but we did get through it. We can get through it again. We just got to get there. But even just sitting on this chart time frame after this high, we got a lower high and then a lower high. And we had a low here and a lower low and then a lower low. Well, when you have two lower lows and two lower highs, that's what we call a full set. And that is a downtrend. It's not a very strong downtrend, but it is a downtrend. So we need to break this cycle and get above Friday's high of last week. Call it 6,150. We can get above that, then we can challenge the high of the week before that, which was also on a Friday. $10-day, 30-minute volume profile, nothing has changed here. TPO looks exactly the same. And as I mentioned yesterday, it's probably going to take at least 2 more days before we start getting into the volume that created this point of control. And so unless we stay in one spot like we are right now, we're building out this level. We can see the volume expands all the way out here. If we don't move out of this level soon, it's very likely that when we come in, 6,100 Monday is going to be where the new point of control is. I'd prefer to be above that level Monday when we come in so that we can keep that point of control underneath us like it has been since it moved down to this 60.76. We still have the VPOC from Wednesday. We didn't get a new one on Thursday, and you can see the very narrow distribution that we've been dealing with since last night. waiting on data this morning. So we got a very narrow IB, unfinished business. Market is wrapped up with a lot of energy and ready to go. We got a preview of next week's range, but remember, it's just a preview. It's not set in stone yet. It won't lock into place until after 4:15 tonight. But as a preview, we can draw a box on our current week's range, and we can lay that on top of next week's range, and we can ask, what's the market pricing in for next week when it comes to movement and volatility? Next week's range is a little narrower than this week's range. Now, at first glance, that would make us say, oh, okay, the market's not pricing in as much volatility for next week as it is for this week. And that would make us, believe that maybe there's not really any big events next week. But that can be misleading. And the reason for that is if you think about things like non-farm payroll or FOMC, they are volatility suppressing events. FOMC is a big volatility suppressor. Now, I know the first time somebody said that to me, I thought, what are you, crazy? Have you not seen the way the market moves at 2 o'clock when FOMC comes out? It's violent. It's moving around all over the place. It's the very definition of volatility. So how can that be volatility suppressing? But the thing is, before we get to FOMC on Wednesday at 2 o'clock, a lot of times Monday and Tuesday, the market doesn't do much of anything because it's waiting on FOMC before it starts making big decisions. So that is the volatility suppression. When a market is going sideways, waiting on data, it's not moving, and movement is volatility. So this narrow range that we're looking at, narrower range for next week, does suggest there's less volatility, yes. But on the other hand, it makes me want to go dig around into next week's economic events and look to make sure there isn't something really big like an FOMC event, and there's no FOMC next week. But some big event that would cause the market to be concerned or fearful and begin to contract and not move in front of that event. We'll see. And on Monday, we'll look at this box again because a lot can change between now and the end of the day, and that range could widen out by the end of the day because it's not set in stone yet. We're still 0.5% above the 10-day. That's fine, but we've had a lot of issues. We've had a lot of issues around this range. We'll just focus on the upside here, where we get stuck under that 1% and we're really not able to expand away from it. So I'd say we got to get through that first. Then we'll worry about 1%. The other side of that is we don't want to get too far away from the 10-day. 1.5, that's about as far as we want to get. If we get further than 1.5, then we have to be concerned about, having gone too far too fast and pulling back, a reversion to the mean. We're still 1.25% above the 10-week. That's okay. I'd like to get above 2%, but it's a start. We're just holding above that 10. We're not really going anywhere yet. So we want to get that expansion, get beyond 2%, and then hold it from there. If we drop back down below 1%, we have risk that we'll just get drawn back into it like a magnet. If we continue to hold around this 1.5%, 1%, then we're still correcting. Right? It's just a correction in time rather than a correction in price. I wouldn't expect much on the equities side of things since everything else is sideways while we're waiting on data. There's always, the individual stock pick, sure, whether, it's earnings or news, a new drug trial, a new product release, M&A deals, there's always something that's making a move on its own. But looking at groups and sectors and themes and industries, I wouldn't expect much in front of events, whether it's non-farm payrolls, CPI, PPI. So we got China up. The top 3 ETFs this morning are all China. They're all up. Then we've got Bitcoin, 2 of those, then China again, which is, it's emerging markets, but it's heavily weighed with China. As much as I disagree with them being labeled an emerging market at this point, whatever. Nat gas, gold. Then we start getting into tech, but once we get under gold, we're below the benchmark. My benchmark is 0.5%. We need to be up or down at least 0.5% to count. If you do your own briefing closer to the open, the whole idea of me doing these is to show you a consistent path that you could use to develop your own approach to a morning briefing. Because I do mine so early, I use 0.5% on my benchmark. But if you're doing it at 9 or 9:15 right before the market open, use a higher number, something like 1.5 or 2%. It is good to see that we have positive things like tech, communications, expanded software. Those are good financials. They're just not up enough, and that's likely because we're waiting on data. Semiconductors down here, green too. So after we get the data at 8:30, we want to see these really begin to push to the upside if we're going to get that nice clean breakout day that we're looking for. We got crude up this morning too. Now, the administration's been doing a lot of work to get energy costs down as it goes into the theme that they're working on for, lowering the cost of everything. So having crude up this morning kind of goes against the work that they've been doing. But markets can't just move in a straight line, right? They have to, well, they don't have to. We want to see two-sided trading. Let's just say it that way. So a little move to the upside is fine. We just don't want to see that get out of control and start making big moves. We can see that chips are up this morning, but it's just a lot of little algo prints. We're not seeing, some real flows in here. That's what we would want to see change. If we look at SMH on the daily, we're above the year-to-date VWAP, just barely, but we're above it. And, sure, it's the year-to-date VWAP, but it's only a month old at this point. It doesn't have much life to it yet. So watch the clock. Let's get through that 8:30 print. By noon, we should have a really solid idea of what our day is going to look like. And unless they hit us with some Friday afternoon data dumps, then by the time we're done with the noon FOMC, let me rephrase that. By the time we get through noon's Fed speaker, the afternoon should be free and clear. Right, so we got this Krugler at noon, and then we should be good past him. My concern is, a lot of administrations, they'll get some negative news and they'll wait until the afternoon on Friday or after the close on Friday, and then they dump that news. I've seen administrations deliberately dump it while the market is still open to get that response. You know, they'll do it at like 2:30, 3 o'clock. So just be watching for that in the later part of the day after, say, 2:30, especially if we're down on the day, because that'd be a real easy way for them to flip things around and run us back up. So that's what I got for you guys. Be careful, be safe, have a good weekend. See y'all Monday.